right, so we're going to go through this Iron Condor scenario, very similar to what we did in NOW yesterday. And we just put this position on in MPC where we sold a $5 wide put spread and we sold a $5 wide call spread. And we collected $325. Now, that may seem like a lot of money, right? That may seem like a big credit, which it is for a $5 wide Iron Condor. Why did we get so much credit? Something had to be, a little bit different than what we normally do. Okay, why would we get so much of a credit? Remember, what do we normally look for reward to risk-wise in an Iron Condor? There you go, Carrie. Good answer. Normally, we look for like 1-to-1, right? So on a $5 wide Iron Condor, we typically want to get a $250 credit so that we could make $250, we could lose $250. Okay? Here, there has to be a reason why we're getting more, and the reason is because one of the options, and in this case it happens to be the put option, is already in the money. So by collecting 3.25, the most we could lose, no matter what, whether the stock went to 0 or 1,000, the most we could lose is $1.75. So that's why the reward to risk went from, what we typically look for at about 1-to-1 all the way up to just a shy under 2-to-1. So think of it, we're getting paid more, but we are taking a little bit more risk. The risk is still 100% defined, but we are taking a little bit more risk. Okay, does everybody understand now the reason why the credit was so high? Okay, and the reason we were so bullish, this is obviously a bullish Iron Condor, is look at this red line, the 50-day moving average, and the support that it has given to this stock over the last 6 months, even over the last 12 months. So we're really playing off of that we're looking for a bounce here in MPC. If it doesn't, that's the added risk that we're taking, but we're getting paid pretty appropriately for the extra risk. Okay, does everybody see that and understand that? Great. So let's go back to our P&L here then. Okay, anywhere below the lowest put, our long put, it's going to be our max loss because all of both put options will have maxed out. Okay, so you can see right here, 190 or lower at expiration, that's our max loss. But doesn't matter how low the stock goes, the value still can't go past $5. Anywhere above 190, we'll start making some money back. And our break even is just slightly above where the stock is trading right now, which is at 191.75. Does everybody see that? That's the 195 put would be worth 325 at expiration. That's what we collected. That's our break even at expiration. Awesome, Joseph. See, this is what you want, Joseph. You want the light bulb to just get a teeny bit teeny bit brighter every day. Big step in the right direction. Awesome. Okay, so anywhere now above 191.75, we're going to start making some money up to a point. And where is the max profit going to be, and what is that max profit? That's one spot. Okay, that's one spot. Yep, at 195. Tom, I think I know what you meant there. You want to correct that? Bingo. Max profit will be anywhere between the short strikes. We have a short 195 put. We have a short 200 call. Anywhere. There you go, Tom. I knew what you meant. Anywhere between those points, all of the options will be worth 0. So that will be our max. Okay, if we start to get above 200, which is our short call strike, still make some profit, but we're going to start giving some back here. And we'll see that our break even on the upside is at 203.25, which is the short call plus the credit we received. So our break evens are 191.75, 203.25. We have an $11.50 area here to at a minimum break even. Again, remember, these prices are all at expiration. Not tomorrow, not Friday, not next Tuesday. These are all at expiration on the 10th. Okay, now if we start to get above 203.25, we will start losing a little bit. But again, that's going to be capped out at the same $1.75 that we saw on the downside. Does everybody see that? So if you can kind of visualize this, and I'll show it on a graph here. If you graphed this out and had a P&L graph, it would look like this. Does that visually make sense to everyone? Why your P&L graph would look like that? What this shows is the max profit up here. Still some profit right here, and then maximum loss here. Okay. So let me actually plot this out and graph it for you here. And what I'm going to do is put the data head here to next week. And here you go. Whoops, I didn't want to do that. There we go. There's the exact shape that we just talked about. And again, you can see that the maximum risk even on here, well, it's fluctuating, is $1.75 if we're lower than the lowest put, and same on the upside if we're higher than the highest call. Does that make sense to everybody? Did the trade produce more premium due to earnings? No, earnings were already out, so the stock is down pretty big. It produced more carry because, as we said, the stock was already in the money for the put that we sold. And Joseph, to your question here, here's Thinkorswim. Here's the same thing on Thinkorswim. So if you go to the Analyze tab up top there, so it's showing you the same thing. All right. Let me get the recording posted up in the room. Let me get the video posted up the room. I'll be back, Gene. When I said risk allocation is 175, well, standard allocation is not based on a contract. It's based on how much risk do you ever put on a trade. And we put this in every trade signal that we put out there. And in every trade signal we put out there, we have that recommendation. So if 2 to 3% of your account is $500, $300, whatever it is, you do that amount of contracts. So let's say you would put up $300 risk on any one trade. Okay. Well, if you have 175 risk per trade on this, you could either do one and keep the allocation a little light, or you can do two and your risk would be slightly higher. We can't split up, the amount of contracts that we do. Has to be in whole numbers. Does that make sense? Does that help? No, that's not what I said, Gene. Okay. The 2 to 3% hasn't changed. The amount of risk, the actual dollar risk on this trade is $1.75 per spread. The percent allocation hasn't changed. Does that help you out? Not quite. Okay. Gene, let's do this. Let's say you have a $10,000 account. Okay. Okay. And let's say your allocation, which should be consistent, is 2%. How much are you going to risk on any one trade? Okay, Gary, that is correct. Gene, that's correct. Okay, so if your risk on any one trade is $200, how many of these are you going to do? Gene, how many are you going to do? How many of these spreads get you to $200 risk or close to $200 risk? Bingo. You're going to do one spread. One spread is $175 of risk. Does that make sense now? Okay, good. Everybody's got that? Everybody understands that? Okay, good. All right, folks. Like I said, let me get this populated, both the spreadsheet and the video populated and put up into the room here. And I will be right back.